In mining, Rio Tinto has signaled an end to the era of record returns in the mining sector as the Anglo-Australian group reported a sharp drop in half-year profit and more than halved its dividend payments. Shareholders won't like that. Rio Tinto, the world's largest producer of steel-making ingredient iron ore, reported underlying earnings of $8.6 billion for the 6 months to June, down from a record $12.2 billion last year on sales of almost $30 billion in top-line revenue. Meanwhile, mining giant Glencore is expected to deliver its best ever results. How? The company said that its trading profit will exceed the top end of its guidance range after it cashed in on volatile markets. Glencore is enjoying two key advantages over its mining rivals, which we're going to talk about with our next guest that is joining us live right now. We're going to speak with, from Idaho, United States, Peter Major, who is the Director of Mining at Mergence Corporate Solutions. Peter, good morning to you. Thank you so much for joining us. Things about 3 a.m. in Idaho right now. What's caused the volatility in prices for iron ore and copper?
Well, it's mostly a combination of, first, the world went into a bit of a recession when COVID first hit. Starting with China, China was the biggest user of iron ore and coal to make iron ore with. So that was at the end of 2019, 2020. Then as we saw that China's lockdown was kind of working and the rest of the world started learning it could still live with COVID, demand shot up extra high because it had been slow before that. And that triggered iron ore prices going from $70, $80 up to $200, $210 a ton. And it's this start-stop, this blockage in the supply chain. A lot of the world was used to just-in-time inventory management, and that includes minerals. It means you don't build up gigantic stockpiles because you have such reliable sources. The Japanese started that decades ago, and a lot of the world went to that. But what happens is, if you don't have big inventories and there is any kind of stoppage in the system, it leads to extraordinary price falls and hikes. And the last 2 years, we have just seen, I'm talking real all-time records. I'm talking 1,000-year highs in real terms, sometimes double long-term averages, triple long-term averages, and a lot of commodity prices. Iron ore being one of them. I think the long-term real price of iron ore is not even $70, and we saw prices at $200. The long-term price of coal is maybe $60, and we see $320. So these are extraordinary prices that lead to extraordinary earnings in the mining companies.
All right. So, I mean, it sounds like there's a whole lot of volatility. So what is it? Is it the best time to be a player in the mining sector, or is it a risky time?
It's the best time to be a trader. Okay. Because when there's lots of market volatility, there's lots of buying and selling. And so Glencore is a trader. Nearly half their profits come from the trading division. And that also balances out things. When metal prices fall, when share prices fall, the stockbrokers still make money. You know, they're the guy in the middle. So Glencore is quite unique in that they have a huge component of their earnings from trading, whereas most mining companies, they earn maybe 10, 15% from trading, if that. They earn most of their money from mining the commodity. Glencore makes a lot of money mining commodities, but it's a much smaller percentage of overall than a traditional mining company like Billiton, Anglo's, Rio Tinto. So Glencore really outperforms mining companies at times. It's very counter-cyclical. When mining companies are falling or rising slowly, Glencore rises much faster. When mining companies are falling in prices, Glencore falls slower.
Thanks for that. So is that a model to follow for other mining companies? I mean, Rio Tinto, we just looked at their results, and there's half of what they did last year. Is it a good idea to have a trading unit that can cash in on volatility in commodity prices?
I think it is. And we've seen Anglo starting to look at taking back some of the trading it did on some of its commodities, because when you are so large and you can lock in to an extra 5% profits even, and definitely 10%, like doing your own trading. And it does reduce your volatility. It gives you better insight into the market. You know, De Beers, they had their own diamond cutting division just to keep abreast of what was going on in the market. And we know diamonds, you know, De Beers made as much money trading diamonds as mining diamonds. So, yes, I think you're correct. I think mining companies are going to look again harder at, we should be grabbing some of these trading profits for ourselves.
Thanks. And so analysts are forecasting big profits for Glencore, I guess, when they release them tomorrow. So you're in that camp that expects them to record some big numbers.
Yeah, without a doubt. And although they had a fall in their copper prices, like most companies, you know, copper fell from 10,000 a ton down to 7,500, 8,000 a ton. We're still seeing great profits in all mining companies. And that's why they're paying near record dividends even still. So when you've had extraordinary profits 2 to 3 times your normal, sure, they can fall a third, you're still double your normal profits.
All right, great stuff. So I guess, what's your forecast then for the mining sector for the second half of the year? Because if there's like some volatility in there, does that mean that this record level of prices will be maintained, or is it going to be cut short? You know, how do you see that playing out?
I think we're going to see profits trending down because these were such high levels of commodity prices. They yielded such high profits. And one thing about mining companies, they have costs, and these costs are relentless. They're always going up. And so we've had high inflation in the world. We're getting double-digit cost increases in all of our mining companies. And so if you've got commodity prices coming off 10 or 20%, sometimes 30%, but your costs continue to rise at 8, 9, 10% a year, that's a double whammy eating into your profits. So commodity prices are still pretty high. I don't see them going up anymore. I see them drifting down, but I see the cost continuing up. So, yeah, profits they're going to continue to trend down, I think. But the share prices have discounted that, maybe too much.
Thanks for that, Peter. And thanks for the insight. We've got here in Nigeria a very, very promising mining sector. But I guess, as you've mentioned, the capital expenditure is probably why Nigeria hasn't realized the full potential of her mining sector as well. The Russia-Ukraine war, can you talk about the impact that has had on volatility in commodity prices?
Well, boy, if you say commodity prices and you include agricultural products, without a doubt. If you include energy prices, which are coal and oil, without a doubt, the Russia-Ukrainian war, it's affected most commodities, but the ones I've just mentioned, the agricultural and the energy the most of all. Because it's not just the war itself that's preventing exports of grain and corn and machinery and some commodities from Ukraine, but it's the knock-on effect. It's sanctions against Russia. The world wants to get away from using Russian energy, and Russia's the biggest producer, second largest exporter of oil, of natural gas, and quite a large exporter of coal. So if the world is going to shun those commodities, naturally their price is going to go up for a bit. Then it might go down, because if Russia has to try and flood the market with these commodities at below market prices, even if they're routed through middlemen. But it's the disruption. And maybe Russia can live without selling 100% of those commodities for a while to try and poke the world into releasing sanctions. So wars definitely add to volatility both ways, up and down in commodity prices.
Peter Major, Director of Mining at Mergence Corporate Solutions, thank you so much for joining us live from Idaho to talk about the mining sector. Really appreciate your time.